Okay, well, welcome everyone to this online public event hosted by the LSE Economic Governance Commission, focused on the global trading system in crisis. We have a very exciting panel of experts here this afternoon to discuss this topic. But first, I wanted to just say a few words about the LSE Global Economic Governance Commission. So the Commission is a forum to encourage debate and devise policy solutions for arguably the most important problems in global economic governance. How do they do that? Well, the Commission holds regular evidence sessions with experts from the academic and policy-making spheres. The Commission also convenes monthly panels pertaining to some of the central themes of global economic governance. So, for example, on trade, as we're going to be discussing with our panel today, but as well as monetary policy cooperation, development policy, climate and tax reform, to name a few. Finally, the Commission is also active in hosting special events such as book interviews with distinguished scholars and policymakers. So as mentioned, today's event is focused on the global trading system in crisis. Maybe just a little context for today's discussion. It's commonly agreed that the growth of the global economy in recent decades has been driven principally by the expansion of trade and investment, as well as the integration of developing and emerging markets into this multilateral based rules global trading system. But the system now seems to be facing a whole host of challenges. These include persistent macroeconomic imbalances due to downward pressure on wage shares, the destabilizing capital flows associated with these imbalances, the subordinate role of low and middle income countries, and a deteriorating trade relationship between the US and China. Additionally, the geopolitical shock of the war in the Ukraine and the sanctions regime against Russia has led to the rise of neo-mercantilist policies and a significant reshifting of trade activity along political blocs. So our expert panel today will discuss these main problems as well as the core reform priorities they see to reshape the policies, the institutions, the laws, and the norms that are required for a stable and inclusive trading system. They'll also explore the main political obstacles, of which there are many, to this reform process. So the format for our hour will be as follows. I will first introduce our distinguished panel of experts. They'll each give some initial introductory remarks, which will be followed by an open discussion, and then we'll have an opportunity to take questions from the audience. Maybe just a few words first about myself as a moderator. So my name is Christine Cote, and I'm an associate professorial lecturer in the Department of Management at the London School of Economics. I'm also the academic director of the SEMS Masters in International Management, and in a previous life was an international trade negotiator with the Government of Canada. Now, the benefit of an online Zoom event, there aren't that many these days, but one of the big benefits is that our expert panel can be joining us from around the world, which they actually are today. So both from Beijing as well as the United States, I think Boston and Washington, DC. So we're very happy to have them with us. We have Danny Roderick, who's the Ford Foundation Professor of International Political Economy at Harvard's John F. Kennedy School of Government. He's also president of the International Economic Association and co-director of Economics for Inclusive Prosperity. We have Michael Pettis. He's professor of finance at Peking University's Guangzhou School of Management. In addition, he's a non-resident senior fellow at the Carnegie Endowment for International Peace with a focus on China. And Ignacio Garcia Bercero is director in charge of multilateral affairs, strategy, and economic analysis at DG Trade in the European Commission. So let's begin with opening remarks by our panel members on our topic of the global trading system in crisis. And I'd like to start with Danny Roderick, please.
Thank you, Christine, and hello to my fellow panelists and participants. It's a pleasure to be with you. I guess I want to make in quick succession 4 points. The first point I want to make is that is that globalization is not just one thing, and that's a kind of a trite point to make, perhaps. But I think there's so much of the discussion today is on whether globalization is dead, whether we're moving backwards on globalization, and so forth. And I just want to make clear that we have a better understanding of what we're talking about, which is that we're really talking about the passing of a particular form of globalization, which I've called, and others have called hyper-globalization. And I think it was a kind of globalization that was very different from the type of globalization that we had under the Bretton Woods regime. So it's really, I kind of dated from the early 1990s with financial globalization becoming the norm, the expectation that countries would be open to capital flows, which of course was very different from the norm under Bretton Woods. And on the trade side, with passing from a model of shallow integration where we were targeting mostly the removal or reduction of barriers at the border, to a model of deep integration in trade, which is that we started to look at domestic regulations, domestic policies as impeding market access and trying to sort of harmonize those or reduce the transactions costs associated with domestic economic policies, whether they were in agriculture, whether it was in industrial policies and subsidies, intellectual property rights, health and phytosanitary standards, and such things. So what we're really talking about is the passing of a particular kind of globalization, and to my mind, it wasn't a particularly good kind of globalization. There are at least two different models of globalization that we've had in the past. One, of course, was the Bretton Woods model, which was a kind of a shallower model of globalization, which I should note resulted in as rapid an expansion of international trade and long-term investment over the long term as happened since the 1990s. So, so it wasn't that the world wasn't becoming sort of international trade investment weren't rising, but it was a model that provided significantly more kind of a priority for governments dealing with their domestic economic and social problems over the priorities of integrating into the world economy. So in some sense, the means and ends were different, that the world economy was a means, it wasn't an end, and it was supposed to serve the ends of domestic full employment, capacity utilization. For example, you can see that in the preamble to the GATT, for example, at the end of the Second World War, which the prioritization of domestic objectives as opposed to simply market access or removing barriers to international trade and investment. So the second point is really to understand what were what was the trouble with hyperglobalization and why it has come to an end, essentially. I think the hyperglobalization sort of exacerbated a number of tensions in the world economy. One was a kind of a tension in domestic economic policies between development policies that pursue the diversification of an economy versus following the dictates of comparative advantage, which is much more about specialization. So there's a tension between reaping the gains from trade, which are mainly through specialization, versus productive diversification. Is a long-term sort of tension in thinking about national development strategies. And of course, China, in some sense, had the best of both possible worlds here, because it pursued a policy domestically of diversification through its own economic management and its industrial policies, while it was essentially free riding on the the gains from trade-seeking behavior of other advanced countries. There was a tension between, again, the gains from trade on the one hand and the distributive effects of expanding trade. And it's part and parcel of international trade theory that the gains from trade come with significant redistribution of income, that those are sort of two sides of the same coin. You can't have just reaping the gains from trade, expanding the size without having significant adjustment and reallocation, which sort of has not just transitory but actually permanent distributional effects, which were largely poo-pooed early on. And there was a tension between harmonizing away sort of national regulatory differences once they were seen in light of barriers to trade, versus the need for national governments to be more accountable to their electorate and therefore maintain those diversity international arrangements. So to the extent that financial capital flows and mobility of capital would drive down, for example, tax rates on capital, it created a tension between sort of what countries wanted to do and what the dictates of international economic integration would call. And finally, there was a tension between the positive sum logic of the gains from trade and comparative advantage and the zero-sum logic of geopolitical competition. As US and China or the Western China competition heated up, as we've seen recently, sort of this zero-sum competition logic of geopolitics has come to dominate and essentially take the center stage over the positive sum logic of the gains from trade. The third broad point that I want to make is that when we take these tensions into account, it still is possible to conceive of a better globalization for the future. I described that better globalization, a kind of a model of peaceful economic coexistence, where the major countries, in particular China and the West, understand and acknowledge that they have significant economic differences in their institutional arrangements, in their policies, and that a world of globalization where we pursue a model of live and let live, where we understand that those differences will persist, and that we are allowed the policy space and autonomy to have those institutional arrangements differ, is a key enabling feature of a kind of a healthy, sustainable globalization. That means that China's industrial policies and its state-managed economy would be largely sort of left outside the rules of global trade. In the same way that the West, the United States, may want to sort of protect its own social safety nets, its labor market arrangements, the integrity of its telecom systems, its own concerns about national security. So it would have the space to prevent investment or trade in those areas where either domestic social contracts or significant concerns about technology or national security would be undermined through deeper trade and investment integration. Now, that might seem like the end of globalization if you allow countries that kind of room. I would argue it's exactly the opposite. I think what we've learned, in fact, from the Bretton Woods regime is that the more you allow national governments to pursue domestic economic objectives such as full employment, growth, development, and equity at home, inclusive economies at home, the more their electorates are likely to be willing to have openness to trade and investment. So I think, in fact, gaining legitimacy for a moderately open world economy is much easier when you have, in fact, these domestic objectives fulfilled by our national governments with less constraints on the part of global rules. The final point I would like to make is that even though it's possible to conceive of a better globalization of the kind that I've just very broadly sketched, I'm very pessimistic that we're headed in that direction. I think, if the mistake that we had under hyperglobalization is that we let big banks and multinational corporations write the rules of the global economy. The risk that we run today is that we're handing over the keys of the world economy to the national security establishments of major powers. And that means essentially not simply having a balance between the zero-sum versus positive-sum logics of economics versus geopolitics, but to have essentially all of economics now be subordinate to the zero-sum logic of geopolitics. And I think that's dangerous. In fact, it's bad for the global economy, but it doesn't even buy us a national security, because I think it actually worsens the security dilemmas of these countries rather than ameliorate them. And I worry that we're on a path that is going to produce neither a more prosperous nor more secure world economy. Let me stop here.
Thank you, Danny. Maybe let's hear next from Michael Pettis. Oh, and
Michael,
you're
right. Am I on now?
Yeah, you're on now.
Great. Thanks very much. I have 3 points that I'd like to make. And there's a certain amount of overlap with what Danny has said, which shouldn't come as a surprise since I've stolen so many of his ideas and concepts. There's inevitably going to be overlap. But of the various, of the 3 points that I make, the first one is, we've been seeing a lot of concern around the world. For example, yesterday, Bill Rhodes had an article in the South China Morning Post making the argument that the reversal of globalization has been historically associated with the rise in geopolitical tensions and all sorts of problems. And the conclusion is that, therefore, we must do everything we can to reverse this reversal, to sort of reestablish and reinforce the existing institutions of globalization. And what I would argue is that we may have the causality backwards, in the sense that the globalization that we have, and I agree with Danny, there isn't a globalization. There are various forms in which globalization can take. And the globalization that we have, I think, has led to a whole series of imbalances, and I would even argue downward pressure on wages. It's one of the reasons for rising income inequality. And it's this globalization that has created the pressures which in turn force a reversal of this globalization process. So if that's the case, then what I would argue is the idea that we must reverse the reversal has it wrong. What we really must do is conceive of the kind of globalization that we want, that benefits the world economy, and move towards that form of globalization. And I would argue, again, I think Danny's made this argument, that this is a very different kind of globalization. Among other things, it's a kind of globalization in which international competitiveness isn't achieved basically by directly or indirectly suppressing wages and household income. I can get into that a little bit later, maybe if there's interest. The second point that I would want to make, and again, I think it's something similar to what Danny's saying, is that we perhaps too often think of the balance of payments as being driven by the trade side. And I would argue, we know the accounting identity, the balance of payments balances, and the capital account and the current account always add up to zero. There's no sense of a primacy. You can only run a surplus by exporting savings, and you can only export savings by running a surplus. Those are the same things. However, it is possible to run surpluses and export savings in very different directions. And I think what's happened in sort of basically since the 1980s, 1990s, is that we live in a type of globalization in which what really drives the direction of the imbalances is not the trade side, it's the capital side. It's notable that most of the trade deficits of the world occur in 4 countries, the so-called Anglophone economies, the United States, England, Australia, and Canada. And I would argue that what they have in common is very open capital markets, well-governed capital markets, very flexible capital markets, so that's the natural destination of the excess savings of the rest of the world. And because of these capital flows into these countries have to run current account deficits, even if they don't trade with the surplus country. And we saw that particularly, for example, with Trump's tariffs on China. Now, I'm very sympathetic to Trump's argument, and in fact, it's not his argument. Quite a number of people have made it, that the U.S. trade deficit is a problem for the U.S. economy. Now, where I think Trump and his advisor Navarro got it completely wrong was on this assumption that the way to resolve the trade imbalance was to put tariffs on the countries with the largest bilateral trade surpluses. Most of the tariffs were on China, but there was talk about tariffs on Mexico and Canada, et cetera. And I think this completely misunderstands the way trade occurs. China runs a surplus because it has a huge savings imbalance, even though China has the highest investment share of GDP in the world in history. It has an even higher savings share, and so it must run a trade surplus. And the U.S. tariffs were never going to affect the Chinese savings imbalance. They would affect them in a very, very tiny way. And as long as China exported most of its savings into the US financial markets, then the US had to end up with a corresponding deficit. So what I argued in my book, Matt Klein and I in our book, we argued that the tariffs would end up reducing the bilateral deficit the US had with China, and of course the bilateral surplus China had with the US, but that would be perfectly matched with an increase in the US deficit in the rest of the world and an increase in the Chinese surplus in the rest of the world. The point is that you can't really look at the direction of trade to understand the sources of the imbalances. What you really have to do is look at the direction of capital flows. And if you want to address the trade imbalances, then you really have to address these capital flows imbalances. Now, the implication, I think, is for many people, and certainly for many Americans, quite shocking. But what it suggests is that as long as the US is the depository for most of the excess savings of the world, there is absolutely nothing the US can do about its trade deficit. Some people talk about twin deficits. If the US were to reduce its fiscal deficit, that would raise the savings rate, which would in turn reduce the American current account deficit. And as we show in our book, that's not true at all. If the US were to reduce its fiscal deficit, if the same amount of foreign capital inflows entered into the US, and in fact, it would probably increase if anything, the US savings rate would be the same, and the reduction in the US fiscal deficit we show would have to be matched either by an increase in household debt or by an increase in unemployment, both of them events that the US would not want to see. And I think that that's one of the biggest misconceptions about trade. The focus on the bilateral account obscures what's really happening in terms of the global imbalances and the role of the global imbalances. As a quick aside, my mentor at Columbia, Michael Adler, used to tell his class, if any of you ever mention bilateral trade accounts, you will immediately fail the course. It's a little bit of an exaggeration, but I understand where he's coming from. The third point that I would make, and it sort of follows naturally from the last one, and this was another thing in my book, I think a lot of people said it really shocked them, and that was the argument that countries cannot necessarily control their savings rate. And above all, the US doesn't control its savings rate. So the argument is that the US runs a deficit because it has very low savings. And what I would argue is it's again, the causality is backwards. The US has very low savings because it runs a deficit, and it runs a deficit because it is the preferred destination for excess savings from the rest of the world. We can later on talk about how inflows force American savings down, but I use a very simple example that I think that shows whether or not you understand the process, why it must be true. And that is that if the rest of the world exports $100 to the US net, then we know by definition, US investment must exceed US savings by $100. The US has a $100 capital account surplus and a $100 current account deficit. So for the gap between investment and savings to grow by $100, either investment had to go up or savings had to go down. And what actually happened, I would say, depends on underlying circumstances. So in the 19th century, for example, when when the U.S. had very high investment needs and quite low savings, U.S. investment was constrained by the total amount of domestic and foreign savings available. So when British and Dutch capital flowed into the U.S., the U.S. investment rate tended to go up. And of course, whenever you had a crisis in England and capital flowed out, the U.S. investment rate contracted very sharply. So in those days, I would argue the U.S. couldn't really control its investment rate. That was determined by domestic savings and the decision of foreigners whether or not to export savings into the U.S. Today, and frankly, in the last 4 or 5 decades, has been very different circumstances. U.S. investment isn't constrained by the lack of savings. On the contrary, for decades, we've had very low interest rates, historically low interest rates, low business investment, and American companies accumulating huge piles of cash, which they use to buy back their own stocks or to buy back other companies for anything except investment. And under those circumstances, it's hard to argue that foreign inflows into the U.S., if a foreigner decides to invest $100 in the U.S. bond markets, that American businesses would use that to increase their domestic investment. After all, if there's no savings constraint, then increasing savings is going to have no impact on investment. And yet, the balance of payments accounting identity tells us very clearly that the gap between investment and savings must rise by $100. So if U.S. savings don't go up, if U.S. investment doesn't go up, then U.S. savings must go down. There are many ways this can happen, and again, I'm happy to discuss them. It can happen through a wealth effect. It could happen through expanding liquidity in the banking system. It could happen through rising unemployment. There's lots of ways it happens. But my point is that the focus on changing the savings rates of countries is really the wrong focus. I will say one last thing quickly, because I know I'm past my time. But before this started, I asked Ignacio if he was from Spain. And I asked him that because I was born and spent a big chunk of my life in Spain. And so I may be a little bit prejudiced, but when I look at the European crisis of 2008, the standard talk was you had hardworking, thrifty Germans and sort of lazy, heavily spending Spaniards, and that was the balance. And of course, that's not really what happened. What happened was that after the 2003 reforms, the labor reforms, German wages went down and German business profitability went up. The savings rate automatically rose. And as we know, in system-wide, savings and investment must balance. Because it increased investment in Spain, a lot of it non-productive investment, but ultimately it had to force down the savings rate, which it did in Portugal, Spain, Greece, Italy, all of the Mediterranean countries at the same time. That's not a coincidence. That's how the balance of payments work. So I'm over time, so let me stop there.
Yes, thank you, Michael. So over to you, Ignacio, for the last couple of words before we open the discussion.
Well, thank you very much. Yes, no, thanks a lot, Christine, and it's really a great honor to participate in a panel with two such eminent professors who have written great books on international trade. What I bring to the discussion is a bit more the perspective of a practitioner, someone who has been working for the last 30 years, basically on the global trading system. My first job was to be part of the team that was engaged in the Uruguay round negotiation that resulted in the establishment of the WTO. And my current job is to try to see how it is possible to reform the WTO so that it continues to be a relevant institution. I would like basically to make 3 points in my presentation. The first one is to give a perspective about this question: have we entered into a new era of deglobalization? Now, if you actually look into the data, it is certainly true that the trade to GDP ratio peaked in 2008, but it is still much higher than it was before the creation of the WTO, or that it was in the previous era of globalization. I mean, according to the data, we have now a trade GDP ratio of more than 40%. Before the WTO was created, it was 29%. In 1913, it was 27%. So we have a world economy which is highly integrated, where there has been a lot of interdependencies that have been established. Now, does it mean that basically globalization is here to stay, and that all this talk about deglobalization is a hype? I think, quite frankly, that there are reasons to be concerned. I mean, it wouldn't be the first time where you actually experience a very substantial drop in the rate of trade integration. It happened between 1913 and 1932. And if you look into the current environment, if you combine the increase of geopolitical tensions, if you look into the fact that the state increasingly plays a more important role in the economy, which is in itself not a bad thing, but which can also create greater risk of potential conflicts between the different economic regimes. And if you look into the reality that support for open trade, particularly in Western countries, has eroded, there is a risk of the generation of a negative feedback loop, which could result in a very risky fragmentation of the world economy. So that would be my first point. We are not witnessing a process of deglobalization, but the risk of going in that direction is essentially something about which we have to be very, very much aware. The second point which I would like to make, and I think I would agree with a lot of the things that have been made, points that have been made by Danny Warwick and by Michel Petit, is that what we need to do from the policy point of view is to imagine, to conceive how you could design a more sustainable model of globalization. Now, a more sustainable model of globalization, from my point of view, would continue to require a functioning multilateral trade institution of a quasi-universal nature. That is to say, the WTO continues to be, from my point of view, a relevant institution, and it would be very, very risky to get into a situation in one was going to consider that the WTO no longer has a role to play. And I would argue there are three fundamental reasons why you need to be able to have a functioning multilateral trade institution. The first one is to avoid that the tensions between the United States and China result in a total fragmentation of the world economy. This would not only be very costly from the economic point of view, it would also be, quite frankly, very risky in terms of the increase of the risk of military conflict. And I would agree with Danny Warwick that a reason to be concerned is the increasing dominance of national security in terms of being the guiding principle for international economic interaction. Now, national security, let's be clear, has a very important role to play. National security is going to have a greater role to play over the next decade than it has been over the last 30 years, but still it should not prevent maintenance of mutually beneficial economic interaction. So I think the first reason why you need to have a system of multilateral institutions is because it should act as a guardrail against a total fragmentation of the world economy. Second point is that the next 10 years are not only going to be very critical in terms of geopolitical tensions, are going to be also critical years in terms of the management of the climate transition. And the management of the climate transition can give rise to increased trade tensions. I mean, we are seeing that today with the discussions about measures taken to prevent carbon leakage. We are seeing it with the discussions about the implications of the Inflation Reduction Act of the United States. All of these actions which countries are taking to achieve an absolutely fundamental goal, which is to achieve climate neutrality, have important trade implications, and you need to have a forum where you can actually try to minimize the risk of trade conflicts. Again, that I would say is an important function for the global trading system. And certainly, I think it's important to bear in mind that while certain developing countries have greatly benefited from globalization and are now highly integrated in the global economy, this is by no means the case for a vast majority of developing countries, which still have the expectation that they will be able to grow through trade and that they will be able to see trade contributing to their development. You have Africa, but you have also other countries which have a limited integration in the global economy. And I think you need to have a trade institution which serves and supports that process. So I would argue that in order to have a sustainable globalization, you need to have a reformed World Trade Organization. But of course, you also need to be very clear that it is not only the trade regime that has to contribute towards sustainable globalization. I mean, Michel Petit has been mentioning a number of very important points about macroeconomic imbalances. I mean, I would argue that these are certainly reasons for tensions in the trading system, but that the response to those macroeconomic imbalances are not really going to come from the trading regime. They're going to come from other aspects of international cooperation, the way it is macroeconomic cooperation or actions which need to be taken at the domestic level. So we should not be assuming that all the issues which are affecting the global trading system have a solution which is internal to the global trade regime. Finally, I just wanted to make a point about policy space. Now, I would argue that there has always been within the international trade regime a scope for significant policy space. Now, when it comes to the issue of national security, there is a very broad exception in the GATT WTO, which in the past for convention has not been used so much, but we have always recognized a significant margin of latitude for countries to take action which they consider to be necessary for their national security. When it comes to the right to regulate for the health reasons, for the environmental reasons, while it is true that there was a potential reading of the rules of the WTO that could argue that there was a strong push in the direction of harmonization, of limiting policy space, the way that the rules have been interpreted by the appellate body, and Bob House has written a very good article on this issue, have been very much in the direction of recognizing the importance of maintaining the policy space and the right to regulate. And of course, there have always been the flexibility within the system, which comes from different instruments to protect on a temporary basis your industry or to respond to unfair competition. So those tools are there. It is clear, however, that within the new trade regime, one would need to look exactly about what is this policy space. I would finally just conclude by saying that I think it will be very important not to throw the baby with the bathwater. I mean, one of the very important achievements of the establishment of the WTO was to establish a system that was full-based and in which all countries, no matter what was their size, would be subject to a binding system of adjudication. Now, that is not the situation today. This is very risky. It is something that can result in abuse of power dynamics. And that's why if there was one reform, which I think would be important to achieve as rapidly as possible, is to find a basis to be able to restore again a fully functioning dispute settlement system. Now, that would require adjustments, that would require dialogue, and we certainly are very aware about concerns that have been expressed, particularly by the United States. But without a functioning adjudication function, you cannot really say that you have a properly functioning rule-based trading system. And my final point, I'm sorry, just I'm going a little bit longer, is I think it's a little bit risky to work on the basis of extreme scenarios. Now, the WTO is not going to have the very central role that those who negotiated the WTO agreements were probably thinking in the 90s. At the same time, it is very difficult to imagine how regional trade agreements can actually properly provide stability to the global trading system if they are not anchored on some common rules which are agreed and enforced multilaterally. So in a way, you need both a WTO that functions better, and of course, countries that wanted to go further than the WTO in the process of economic integration have the option to do so through different forms of trade agreements. And in any event, there's always going to be a certain sphere which would be governed by national security considerations, but hopefully this is something which can be contained and delineated, and it doesn't become the paradigm on the basis of which all international economic interaction should be judged. So I think I'll leave it there.
Okay, thank you, Ignacio. We have about 10 minutes where I want to invite you to engage in more open discussion, maybe, feeling free to address some of the points raised by some of the other panel members. And I think you've all sort of highlighted what you see as some of the greatest challenges, whether it's, preserving domestic policy space, controlling capital flows, savings rates, or preserving or reforming the existing institutional arrangements with respect to trade rules. I guess my question, or sort of to just launch off a discussion amongst you, to what extent do you sort of agree with what these challenges are? And more importantly, sort of what can policymakers do both domestically and maybe either collectively at the regional or multilateral level to address some of those? Because you've all sort of come at it from different angles, but maybe I'll just open it up to a more open discussion amongst you based on the statements that have been made, and then we'll go to questions from the audience. I don't know if one of you want to, kick off in response to some of what was said by your co-panel members, Danny or Michael, if you, one of you wants to maybe take the lead.
Danny, do you want to address that?
Well, I mean, I think there are two broad set of issues that if we focus on the advanced economies in particular that are at the very top of the agenda. One is the issue of the green transition and the climate change issue, which Ignacio mentioned. The other is repairing the social fissures and the problems of inequality and labor market polarization that have been aggravated by the policies of the last, the hyperglobalization, market fundamentalist policies, neoliberalism, and so forth, that also Michael made reference to. So I think those are, on the climate change issue, obviously the first best would be if all countries should, I mean, if there's one area where we need global governance, right, it would be climate change. Unfortunately, I don't think we're going to get the kind of cooperation we will there. And so we're likely to see local, national, regional responses. And we should encourage those, and we shouldn't let global trade rules stand in the way. So just like, I think it's more than okay for the European Union to consider border adjustment mechanism for carbon, essentially tariffs on dirty goods, if Europe is to maintain a high carbon price domestically, even though it certainly would violate the spirit, if not the letter, of WTO law. I think it's it's okay for the U.S. to be subsidizing its green technologies and so forth without Europe complaining about it. So I think these are, we are at a stage where we need to understand that these issues, to the extent that they're being addressed by domestic or regional governments, they should take precedence over sort of a kind of a very traditional understanding of WTO and multilateralism. And I think I don't see it completely internalized yet in the policymakers. I don't want to speak too much, but I think on the second set of issues with respect to more inclusive domestic economic policies, again, there are many things that countries are going to do through a variety of industrial and other policies that might conflict either with financial globalization or international trade rules. And again, I would put the priority on pursuing those instruments rather than privileging economic integration.
Michael?
What I would like to focus on really is the way the change occurs, because I think when you think about this process of change, it's not a very optimistic or very happy set of prospects. So for me, one of the big problems that we have with the current form of globalization is something that is not really new. It's something that we knew. And if you look at the agreements, the old Bretton Woods negotiations, both Harry Dexter White and Keynes, especially Keynes, were very concerned about a global system in which countries became competitive, basically by repressing domestic demand. And what Keynes insisted on was some sort of discipline that forced the adjustment not just on the deficit countries, but also on the surplus countries. And his reasoning was quite straightforward. Deficit countries adjust by constraining domestic demand, and surplus countries are supposed to adjust by expanding domestic demand. And if you put all of the adjustment pressure on the deficit country, then you have a natural deflationary tendency in the global economy. And that was something that worried him a great deal. He was, after the experience of the Great Depression, which was partly driven by beggar thy neighbor trade policies, he wanted to put an end to that. And unfortunately, we don't really have, I frankly think that Keynes's argument for Bretton Woods was better than Harry Dexter's, although they agreed on many things. So I think if you want to change the system, there's basically two ways you can change the system. The good way is that we organize a new Bretton Woods and all of the major trading economies get together and agree on a new set of rules in which there are significant constraints on the ability of surplus countries to continue running surpluses. And remember, surplus countries don't run, the common stereotype is that Germany, China, Japan, South Korea, they're hardworking and thrifty. And that's not why they run surpluses. In all of those countries, it's very clear that the household income share of GDP is much lower than in their trading partners. So basically, you achieve competitiveness by directly or indirectly suppressing household income. And that forces everybody in the world to play the same game of suppressing household income. Now, if you weren't able to export the savings imbalance, you would be forced to resolve it domestically. And there's three ways you can resolve it domestically. One way is by significantly increasing domestic investment. The other way is by significantly increasing unemployment, contracting GDP. And the third way is by transferring income back to the household so that they can increase their consumption and absorb all of this excess production. But in an open trading environment, the easiest way to resolve this problem is simply to export the excess. And if you were exporting the excess to developing countries, that would be great. That would force up the investment rate in developing countries. But as we know, almost all, something like 80 to 90% of the excess savings of the world are exported basically to the Anglophone economies, to the rich countries. So it doesn't have that impact on boosting demand. So it's, in my opinion, it'll be very, very difficult to convene a new Bretton Woods because the interests of the surplus and the deficit countries are so different, sorry for that, are so different. And of course, the US represented something like 50% of total manufacturing capacity of the world in 1944. So it could impose its will. Today, it's about 15 to 18%. So it'll be much more difficult. That's one solution. That's the good solution. We get smart and put together a much better functioning system of globalization. The other system, the other way of doing it is for the US unilaterally to impose changes on its ability or on its role in absorbing global excess savings imbalances. And there are many ways it could do so. I think it'll be hard for it politically because this would fly in the face of Wall Street interests and a number of others. but basically it would be focusing on the capital side. That would be terribly disruptive for the global economy, particularly for the surplus economies. So that's the second way of doing it, but it's the bad way. Unfortunately, I don't really see any alternatives. Either the US continue running these deficits indefinitely, and as its share of global manufacturing contracts, the cost of these deficits will be greater and greater, or it convenes a new Bretton Woods, or it unilaterally decides to solve the problem. I wish I could say that we would follow the second path, but I doubt it. I think it's more likely to be the third path.
Ignacio, did you want to comment?
Yes, no, I would like to comment on the comment that has been made by Danny Warwick about climate, and then perhaps to make a more general point about the perspective for reform. Now, I mean, in an ideal world, of course, it would be highly desirable if you had a very strong climate regime in which you actually had an international agreement on carbon pricing. That's not the world in which we are living, and that therefore it is very clear that countries have to identify autonomous actions to achieve the climate transition objectives. And that is going to inevitably have an impact on trade. The question and the challenge is how to design your autonomous actions in a manner that does not discriminate, that doesn't impose a burden on foreigners, which is higher to the one that you are imposing on your own producers, or in which you are creating very significant negative spillover effects. Now, I don't think we have the time to have a big debate about the carbon adjustment mechanism or about the IRA. Our concern with the IRA has to do with the fact that the way that the subsidies have been designed, they are having a significant discriminatory impact on Europe. And that's why we have a concern that we hope that through dialogue can be solved. And what you really need to have in the WTO is not the WTO imposing itself on the climate actions, but providing a forum where countries can discuss the issues, can cooperate, not necessarily to negotiate rules. I think that something the tendency to think that everything in the WTO has to be rules negotiation, but to reduce tensions and to increase the compatibility between the different actions which countries are taking. The final point is that I am not very optimistic about the conditions being there for a big new Bretton Woods reform. I think it is very difficult to see how that is reconcilable with the current geopolitical context. But at the same time, I think it's going to be extremely important that the United States and China are able to agree that while engaging in a strong competition, including on technology, they have a common interest on cooperating on some issues which go to the maintenance of a rule-based global system, including in that connection reforming the WTO. At the end of the day, I think reforming the WTO would only be possible if the United States and China, together with others, including, of course, the European Union, are ready to invest political capital about doing those reforms which would be necessary. And that implies negotiating with each other, and that implies being able to accept that it is possible to compete strongly on technology and still maintain normal economic engagement in our areas.
Okay, so I think there's so many strands of possible debate and discussion, and very few minutes left. I'm going to go, because we haven't left too much time, just to picking up on what Ignacio was just talking about, a question from the audience. So it's from Quinn Slobodian. I'm not sure where Quinn is from, and he's asking if Danny Roderick and Michael Pettis see a role for a reformed WTO at all. It's clear that Ignacio does. So maybe I just throw that question out to the two of you out of curiosity to see where you stand on that. So this is from Quinn Slobodian.
Let me answer first, because my answer will be very short. I think it'll be very difficult for a new globalization regime to emerge out of a reformed WTO. Danny?
Yeah, I mean, I think it'll have to come from a US and China will have to find an accommodation first, and then it might be possible to translated into a kind of a new WTO or new understanding of the multilateral trade regime, but I think would have to be settled bilaterally by the US and China first.
Any comments, Ignacio, before I go to one more question from the audience?
Well, I think, I mean, on the point which has just been made by Danny Bobik, it is clear that there is no political will by the United States and China to cooperate in WTO reform. WTO reform will not happen. At the same time, we are not living in a world where the US and China can agree on something and then dictate the rules for the rest of the world. So a process of reform the WTO is going to have to involve many, many other players. It's going to certainly have to involve us, the European Union. Is going to have to involve also developing countries. And the critical question is the United States and China ready to understand that they have a common interest to invest in this process? And that, I think, is going to be the fundamental challenge. It's not going to be simple. I wouldn't say so, but I'm a little bit more optimistic than Michel Petit on this point.
Okay, just a couple minutes left. I have a question from Sam Malloy, LSE School of Public Policy. What do the panelists think are the prospects for a broader decoupling of the global trading and financial systems, particularly between US and China blocs? Do they think any decoupling is likely to be limited to goods important for national security, given the financial dynamics driving global imbalances and proven difficult to fight against? Maybe we'll, I don't know, over to Michael, maybe on that one to start.
You know, when I try to think of the benefits of a more integrated global system versus a less integrated global system, the standard argument is that the bigger the economy, however, whether we define it as a country or as a globe, the bigger economy, the greater the economies of scale. And so the strongest argument for maximizing trade around the world is that you have greater economies, potential economies of scale. But I wonder at what point they begin to taper off. So for example, is a global economy that much more efficient than a large economy like the United States or like Europe or like China or other countries? I don't know, but I'm not sure we should assume a linear relationship. So I think, you know, I don't think anybody is in favor of a breaking up of the global economy into trading blocks. But I think we have to be very careful about the costs of that breaking up. And the costs must exceed the benefits. Otherwise, there isn't a problem with breaking it up.
Any comments from Danny or Ignacio on that issue? No. I'm afraid that we are out of time, sadly. A whole host of questions still there in the chat. I think this has been a really interesting discussion, many different strands that we could be pursuing. I think it's provided some interesting insight into possible solutions or ways of tackling these challenges. So a big thank you to our panel of experts. I'm sorry we didn't have more time to sort of pursue all of these different areas. And thank you to the audience and for some really interesting questions. And I'm sorry we were barely able to scratch the surface with those. I encourage the audience, you know, to look into future debates and discussions hosted by this LSE Global Economic Governance Commission. And then again, just a big thank you to the panelists, and I guess a goodbye to all, because we've now reached the end of our hour. Thank you.
Thank you very much. Bye-bye.
Thank you.
Thanks a lot.